Hello, I'm Locke Meredith with Legal Lines, and I'm pleased to have on our next show Bill Barkas. He's an insurance agent with State Farm Insurance Company. It's the largest automobile insurer in not only the state of Louisiana, but the nation. It's a reputable insurance company, and we're going to talk about insurance, and particularly automobile insurance, and coverages that we think you need to have. So join us on the next Legal Lines. Hello, welcome to Legal Lines. I'm Locke Meredith. I'm pleased to have on the show Bill Barkas. He's an insurance agent for State Farm, which is the largest automobile insurer in the nation and provides most of the insurance in Louisiana. Bill, thanks for being on the show.
Thanks a lot. Thanks for having me.
Let's give the folks a little personal information. You've been an agent for how long?
Been an agent with State Farm for 15 years.
And that's been the only employer?
Only insurance company that I've worked for.
Right.
Is State Farm.
Describe what you do for State Farm as an agent.
Well, as an agent, I represent State Farm only, and I market State Farm products to a book of business that I have, and I represent my clients as an agent also.
And there are multiple agents all over the state and the city, in fact.
Correct. Right.
Now, you heard my intro. As I understand it, State Farm is the largest automobile insurer in the nation.
In the nation.
And also the largest automobile insurer in the state.
In the state of Louisiana.
And that's part of the reason I wanted to get you on the show is talk about it, since they're the big dog, so to speak. Billions of dollars in assets.
Correct.
And what we're talking about is insurance that folks buy, and the insurance company with basically whom they are contracting to provide coverage to them in the event they suffer some type of injury or they injure somebody and they need to be protected from a lawsuit. That's basically what we're talking about.
In Louisiana, you're required to carry a minimum from the auto insurance side, 10, 20, 10 liability.
And there are all kinds of different insurance products that are sold, and State Farm sells what? What are the differing products?
We sell
insurance
State
products?
Farm markets auto insurance, homeowners insurance, life, health insurance, and also business insurance.
Okay, and then do y'all also provide the umbrella policy, which is basically on top of all of those?
Right, any other type of fringe coverages or additional liability coverages or other fringe coverages.
I would imagine most folks are most familiar with the automobile insurance policy.
Right.
Let's talk about that, because in essence what that is a contract that a person who needs insurance enters into with, in your case, State Farm Insurance Company. Okay? And that contract delineates or outlines what State Farm's obligations are in the event certain things happen.
That's right.
All right. When somebody comes in to buy insurance from you for their automobile, describe the process that you have to go through for them to purchase insurance.
What we try to do on each person that we talk to is evaluate them through a series of questions and conversations about what their particular need is. What one person needs may be completely different from what another person needs based on their amount of income they make, their assets. So there's a lot of different factors. So we try to educate ourselves to their situation.
So the primary goal of insurance is to protect your assets.
Protect your assets, to protect yourself. And also publicly to protect other people. If I'm involved in an accident and I injure someone, then I have a responsibility to take care of that.
So it does a few things. One, it protects your assets from being taken from you, while ensuring that someone else who's injured by your fault is taken care of. Those injuries are paid for.
Exactly. And the state requires a minimum limit of 10, 20, 10. All
right, let's talk about what that means. The first 10.
The first 10,000 is for bodily injury per person.
So if I'm driving down the highway and I run into the back of you, okay, and your medical bills are $20,000, let's say.
And I have limits of 10, 20, 10. The most that one person can collect is $10,000.
The most you can get from my insurance company, if I have a 10, 20, 10 policy, is $10,000.
That's correct.
Now, that's for the medical expenses.
That's medical. We call it bodily injury, which includes medical, lost wages, pain and suffering, any other things that go along with
if my medical
bodily injury.
So if my medical bills are greater than that $10,000, it doesn't matter how much all the other stuff is worth. All I'm getting for my injuries, if I'm hit by somebody, and all they have is a 10, 20, 10 policy, is $10,000.
That's correct.
Now, the damage to my vehicle.
The second number, the 10 is the bodily injury per person. The 20,000 is bodily injury per accident. So if there's more than one person in the accident, that 20,000 is split among them pro rata based on their amount of injuries.
So if I'm driving down the street and you and I are in the car together and somebody runs into the back of us and you've got $10,000 in bills and I got $10,000 in bills,
we'll split that 20 among the two of us.
Because the most we can get from a 10-20-10 policy is 10 each.
10 each.
Even if you had damages of $1 million,
right,
and I had damages of $1 million, the most we're going to get under that insurance policy that person who hit us is $10,000.
Correct.
And then if my car has $20,000 in damages, it doesn't matter. All I'm getting is $10,000.
$10,000 for the property.
Because that's the limit. So
which
the first
is the third
10,
number,
okay,
the 10,000.
So the first 10 is the maximum amount any claimant can get.
Correct.
The 20 is the maximum amount that policy is going to pay no matter how many claimants are out there.
Mm-hmm.
And the last 10 is the maximum I can get
for property damage
to
the vehicle.
Okay.
Or any other type of property. Maybe you hit a house or you bump into a gas pump when you're pumping gas. Things like that are considered property damage.
Now, you mentioned that the state legislature has written in a law that says everybody who drives a vehicle in the state of Louisiana has to have at least insurance in the amount of 10-20-10 to do what we just talked about.
Right. If you have a registered vehicle, you have to maintain insurance at least 10-20-10. Anything over and above that, you could be held responsible for if you cause damage to someone else. So and that's why we want to look at the person's situation. Some people may need more limits than 10-20-10.
So if I'm driving along and I smash into the back of somebody and they have a $1 million case because they break their back or something,
right,
and all I have is a 10-20-10 policy, State Farm's going to pay $10,000 to that fella, and that fella comes to me
to get
and gets a judgment against me for $999,000 or $990,000. Because all that insurance is going to pay is $10,000.
That's correct.
So if you have assets that are greater than $10,000,
those need to be protected.
And the way you do that,
increased limits, you can go. There's different mixes. You can go 10-20-10, 25-50, 50-100, on up to some single limits of $1 million or $500,000, and then after that you go into an excess, which would be a personal umbrella,
which basically pays above whatever the automobile liability policy pays.
And that also, what the personal umbrella does, it will include not only the auto, but if you have a homeowner's policy, it will cover you for anything that you're personally liable for. Not necessarily auto related, but anything that you're personally,
all right,
any personal injury.
I'm sure a lot of folks have gone into an insurance agent's office and they try and get insurance and they're either declined or they're charged a premium and they say, I'm out of here.
Mm-hmm.
Ain't no way I'm paying that. How do you guys, or how do the companies go about determining whether or not they're going to write insurance to somebody, enter into a contract with them, or the premium they're going to charge?
Well, of course, there's two questions there. First of all, there's an underwriting process. It's based on driving history and some other factors,
so
age,
if I'm cruising
like
around
that,
bumping everybody in the back of their car, I'm not going to...
Right. The chances of you being able to get insurance is very low. And, you talked about rates. The rate is all determined by several factors, including driving record, age of the driver, the amount of, miles they drive to and from work.
All right.
So there's a lot of factors involved in that.
Let's talk about those factors on the next segment, and then we'll get into homeowners insurance. This is Legal Lines with Locke Meredith, and we'll be right back. Welcome back to Legal Lines. I'm Locke Meredith, and pleased to have on the show Bill Barkas. He's an insurance agent with State Farm, which is the largest automobile insurer in the nation, and Louisiana also. Again, Bill, thanks for being on the show. We were talking about the factors that the insurance companies use to decide how much of a premium is going to be charged. Mm-hmm. Go into a little more detail.
When you look at the big picture, first of all, the premium is comprised of, claim payments, and also we are take into consideration the investment income that we can earn on the premiums that we receive. And then in addition to that, our company expenses are included in there. And so what we do is we base our premium on the risk factors involved, which include the age of the driver, the mileage they drive to and from work, the sex of the driver. Younger males are more expensive to insure than younger females.
That's bad news. I got 3 boys.
And I do too. You know, we got 2 boys. The younger males tend to have a higher incident of accident than the younger females. The grades are factored in there.
So y'all look at all kind of criteria to determine whether somebody's going to be a reasonable, responsible driver.
There's a huge, you know, we have a base rate, but there's all kind of factors that are actuarially calculated in there to determine discounts and charges.
So you have this basic rate that you charge somebody for insurance, but then you add to it or deduct from it based on whether or not they meet the criteria of either being a responsible person or an irresponsible person.
Correct.
And then the base rate that you use as a company is determined by the loss history of, say, Louisiana, how much they had to pay out in claims in Louisiana for the year, and then compare that with whether or not they earned very much money in the stock market or wherever they're investing the premiums that they collect.
That's correct.
Okay. And that's how they decide. Now, what does a person do when they go into State Farm and they're declined for insurance? Do they have other options available to them?
There are certain other options that they have available. There are certain companies that will take a higher risk type of individual. There's also the Louisiana Fair Plan, which or the Assigned Risk Plan, which is a program that's established by the state for people that just cannot get any insurance through the standard market or the supplementary market.
What is the base rate for a 10-20-10 policy with State Farm? Do you know? Right offhand, just an estimate.
Not offhand. I mean, the base rate on a 10-20, just the liability portion, we're probably looking at, you know, somewhere in the neighborhood of $120 every 6 months.
Okay, so it's not that expensive.
It's not that expensive,
right.
But when you look at a factor of 4.0, 4 times that for a 15-year or a 16-year-old male without good student, without driver training, then it
adds up real
significantly goes up. So what we do is we take that base rate and we multiply a factor by that based on, you know, the risk factors involved.
Let's talk about the kinds of automobile insurance that is available. We talked about the liability portion of a policy, and that's the 10-20-10 bit. There's also collision coverage. Explain that.
The policy, the auto policy, people will use the term full coverage. I want full coverage. Well, there's no such thing as full coverage.
That's right. I have so many folks come in and tell me, I got full coverage, and I'm going, well, that may not be what you really think it is. Let's define liability first. In essence, if all you have is liability insurance, what does that take care of?
All you're doing is you're protecting your own assets in the event that you hit someone.
In other words,
and you're protecting the other person.
Right.
We're going to pay the other person if you hit them.
So if all you have is liability insurance and you go crash into the back of somebody, guess what? You got to pay for the repairs to your own vehicle, and if you're hurt, too bad, you got to pay for it. That insurance only takes care of the person who you ran into.
Right.
All right. Now let's talk about collision.
Collision, and like you said, there's several parts of the policy. The collision portion takes care of damages to my vehicle in the event that I collide with someone or turn the car over or any other type of accident like that.
So any damage that I cause myself,
right,
my own insurance policy is going to pay to repair that vehicle.
Or if someone hits me that does not have insurance, the collision will pay for my vehicle. So it's for physical damage in the event of a collision.
To the vehicle?
To the vehicle only.
Right. Okay.
Then there's comprehensive, which is a broad coverage for physical damage to the vehicle for anything other than a collision loss. It would be the vehicle catches on fire, the vehicle floods, the vehicle gets stolen, a limb falls on the vehicle. Those fall under the coverage of comprehensive.
And again, only
you can have one or the other.
And again, only taking care of the damage to the property.
To the property.
Does nothing for you if you're cruising around and you get physically injured.
And really, all insurance, all property and casualty policies have property protection and liability protection. In addition to the comp and collision, there's medical payments coverage.
Now, what is that?
I can purchase for myself that provides for medical expenses for me or any of the occupants in my vehicle if they're hit by, no matter who's at fault.
So if I'm driving, let's give an example. So if I'm driving down the road, you and I in the car, and we got our boys in the back, and I run into somebody, and they don't have insurance, or I run into somebody, whether or not they got insurance or not, I've
your
got
medical
med pay,
payments will cover that.
And there's a limit on each of those coverages.
Right. We go from 1 to 100,000.
Okay. And of course, I guess whether or not you get that kind of coverage would depend on whether or not you got health insurance.
There is some coordination of the benefits, but for the most part, you know, it's the first dollar. I mean, you're paying for that coverage and you're entitled to collect.
Yeah, I guess my question in the analysis, whether somebody's going to get med pay would determine whether or not they have health insurance that they think is going to take care of their medical expenses anyway. Of course, that doesn't help somebody who's riding with you.
Well, and we look, that's one thing that we try to do when someone comes into our office. We try to evaluate their situation. A person that has group health insurance may not have as great a need for medical payments covered.
Right.
A person that has an older vehicle may decide they don't want to put that money to protect that vehicle in case it gets wrecked because it may not be worth it.
So they may not get collision.
They may not get collision.
Or comprehensive coverage because their old piece of junk's worth $100. Mm-hmm. Okay. Now, there is also UM insurance, and there's really three kinds of UM insurance. There's UM insurance that pays for bodily injury to somebody. There's UM insurance that pays for only their economic losses, lost wages, medical expenses, stuff like that. And then there's UM coverage for damage to the property, to the vehicle. Let's discuss each one of those. First, let's talk about the property damage, UM.
Okay. On the uninsured motorist for property damage, and it's a very confusing concept to most people because they think uninsured motorist, well, that's going to pay for my vehicle. Well, on the uninsured motorist for property damage, that is designed to pay for damage to your vehicle if you're hit by someone who does not have liability insurance.
Or they don't have enough.
Or they don't have enough.
So let's say, so if I'm driving down the road and somebody hits me and they have a 1020 policy, but I have a $20,000 car and it's totaled out, I get 10 grand from the guy that hit me, and then I can turn to my own insurance and say, give me your other 10. Okay.
Coverage.
And the way you get that is you got to expressly ask for that kind of coverage.
That's correct. The state has established a form that the policyholder has to select if they want UM for property damage, if they want UM for bodily injury, or if they want UM economic only.
Let's talk about UM economic only now.
On the economic only, that's something that's fairly new that is designed to pay strictly for economic loss, which would be medical or lost wages.
Let's talk about the economic UM and the UMBI on the next segment.
Okay.
Locke Meredith with Legal Lines, we'll be right back. Welcome back to Legal Lines. I'm Locke Meredith, and speaking with Bill Barkas. He's an insurance agent for State Farm for 15 years, and we're talking about insurance. Pretty important topic. Bill, again, thanks for being on the show. We're talking about UM coverage, and we talked about that there's UM property damage, which basically pays in the scenario where if my vehicle is damaged in a collision, and the person either has no insurance who hit me, or they only have minimum limits and it's not enough to pay for my damage to my vehicle, I can turn to my own insurance company and say, please pay that.
That's right.
Now we've talked about briefly economic UM coverage, and that's dealing with the scenario where if I'm driving in my car and somebody runs in the back of me and they don't have insurance or they don't have enough to pay for certain types of expenses, I can turn to my insurance company and say, hey, I need help.
I need help.
And what are those particular type of expenses that economic UM only pays for?
Okay. The distinction between the economic only and the UMBI is that the economic only is limited strictly to medical reimbursement and lost wages. Anything that is a monetary loss to that individual.
Okay.
Intangible things that
for pain and suffering, scarring, disability, all that
are out the window.
Economic UM is not going to pay you any money for those things.
That's correct.
The only thing economic UM will pay for is if somebody hits you and they don't have enough insurance or they have no insurance, it'll pay you for your medical expenses and it'll pay for your lost wages.
That's right.
That's the position.
That's it.
That leads us to the final type of UM coverage, which frankly I tell all my clients and everybody I can talk to that they need to get, and that is UMBI, because that's the kind of insurance that pays for the situation when I'm hit by somebody and the bozo who hits me doesn't have any insurance or they don't have enough, and I'm busted up bad, broken legs or whatever, and he doesn't have enough to take care of me, I can turn to my own insurance and say, help me.
Right.
And in that case, we're not talking about just payment of economic only, although it does. UMBI will pay you for your medical expenses, your lost wages, but it also pays you for the physical injuries that you suffered, the pain and suffering and the scar and all of that, and the future loss wages.
Right. And there's so many intangibles that are involved in an accident that you don't take into consideration. The loss of convenience, potentially losing a job, as a result of not being able to go to work. I mean, those are things that are being replaced with that UMBI.
I think it's the most important kind of insurance you can buy because, frankly, it's the only insurance that you're buying that's for you.
That's
that protects you.
Well,
if
the
somebody
physical
hits you,
damage is
right, I'm talking
provide
about for the physical, the injury to your body.
Mm-hmm.
The only kind of insurance you can buy if somebody hits you and really messes you up that will protect you, where you're able to protect yourself
mm-hmm.
from somebody else, is that UMBI.
Mm-hmm.
And as you well know, we talk about it often, that is such an important insurance that Louisiana legislature, a law has been passed that says unless you waive that insurance, unless you sign a document waiving UMBI, you automatically have it.
That's correct.
And the limits that you have in that scenario are what?
Well, the limits are the same as whatever bodily injury limits you carry. If you carry 10-20-10, then you have the opportunity to carry 10-20 UMBI.
In fact,
or
you get it automatically.
You get it automatically unless you sign that form. That's correct.
Okay.
And that's been a contention, in the past, is that, people have to make a decision on, which type of coverage they want.
Right.
And what we do is, certainly the UMBI is the better coverage, but it's more expensive. And when we're talking with clients, there are times that they have to, make a decision on, what they want to cut and what they don't want to cut. And we try to help them make that decision. A person who has good disability insurance, good life insurance, good long-term care insurance may have less of a need for the UMBI than someone who does not have any of that type of protection. But that's just an added buffer.
Right, but none of those insurances will pay for the damages sustained as a result of pain and suffering. If you get your leg cut off or your arm or anything of that sort, doesn't matter whether you have a bunch of health insurance or disability insurance or anything. Those are dealing more with the economic losses. The only insurance you can buy to compensate you for your physical bodily injury is UMBI.
That's correct. That's
and,
right.
And that's why, and I think that's why the state has determined it's so important that you automatically get it when you buy any liability insurance
mm-hmm.
policy. And we need to be clear. You said it, but I want everybody to understand that if I go buy a 10-20-10 liability insurance policy, I automatically have UMBI insurance
unless
in the
you
amount
sign
of
that
10,
waiver,
right? In the amount of
you don't want
10-20. And that not only will pay for any bodily injury to me and medical expenses that I would incur or lost wages that I would incur, past or future, but the person sitting next to me who I love or who's a best friend and who's messed up bad.
Right.
And so I can't stress it enough how important I think it is. And obviously the state does too because they give it to you automatically.
Mm-hmm.
Well, let's talk about the waiver. It gives you, you said, it's a form that has been promulgated or put together by the Commissioner of Insurance, and it's a form the insurer has to use, and you guys basically explain the policy and you say, here's the UM waiver, and you either have limits equal to the amount of your liability coverage, or you can select higher limits or lower limits.
Well, you can actually select, you can select less.
Lower
you can't
limits,
select
right.
higher than
I
what you have.
And, or you could select only economic, which again only pays you for your lost wages and medical expenses, or you can waive it.
You can completely waive it. And some people choose to do that. And mainly it's just an economic decision that they make to waive that particular type of coverage.
Right. Let's talk about quickly the other types of products. You talked about homeowners. Describe what homeowners does for us.
Homeowners basically pays to repair your home in the event of a fire or any other type of casualty that would occur other than flood. You have a separate flood policy.
All right.
And as with any property and casualty type policy, there's designations of coverage. You've got property coverage and then you've got liability coverage.
So if I'm hanging over at your house and I trip over something and it's really bad news, bad defect, your homeowner's insurance policy will protect you against any suit I might file against you because I'm hurt bad.
Right.
So
if my dog goes out and bites someone, then I'm responsible for my dog and the homeowner's policy.
So the homeowner's protects your property, your house, and it protects your assets from suit.
Right.
Okay.
And also there's some other coverages in there for loss of use of the dwelling, For example, the house catches on fire and you can't stay there. Well, most companies will pay to put you up in a hotel, some additional living expense and things like that.
Then the life insurance basically paying when we're all going to die, so it's going to pay a certain benefit depending on the type of policy it is when you die to whoever you designate as the person to receive it. And then we talked about the umbrella policy, which if you have a homeowner's policy and an automobile liability insurance policy, you can get an umbrella policy that picks up protection for
liability
you over and above those limits here.
Right.
Okay. Let's talk about the interesting state of affairs as it relates to regulation of the insurance industry quickly. Explain that to me.
Well, unfortunately in Louisiana we've got some problems within our industry. The rates, when you look at our rates compared to most states, we're probably, from an auto standpoint, we're probably third or fourth highest in the nation, whereas our per capita income is on the lower end. So consequently, a lot of the high percentage of people's income is paid toward insurance.
So premiums are high in Louisiana, and the question is how we solve the problem. I think we're going to have to address that on the next show. Bill, thanks so much for being with us.
Thanks a lot, Locke.
This is Legal Lines with Locke Meredith. Thanks for being with us.